are lies so thoroughly integrated into organizational systems that they cease to feel like lies at all. They become simply how things work, the background assumptions that structure daily operations, the accepted practices that everyone participates in without conscious recognition that participation constitutes complicity. Virex Solutions, a mid-sized consulting firm occupying floors 12 through 17 of a glass tower in the city's financial district, had been operating under such a lie for 7 years, though most of its 340 employees would have been genuinely shocked to learn they were working for a company that had built systematic dishonesty into its most fundamental financial architecture. The building itself embodied a particular aesthetic of corporate legitimacy, floor-to-ceiling windows offering panoramic views of the city skyline, polished marble floors in the lobby, security systems requiring badge access at multiple checkpoints, conference rooms named after inspirational concepts like innovation and excellence and integrity. The interior spaces were designed according to contemporary open office principles, rows of workstations with minimal partitions, glass-walled offices for senior staff, communal areas with expensive coffee machines and ergonomic seating meant to foster collaboration and creativity. Everything conveyed success, professionalism, the kind of established corporate presence that reassured clients they were working with a stable, reliable organization. Virex Solutions provided business consulting services, helping clients with organizational strategy, process optimization, technology implementation, change management. The work itself was legitimate. Teams of consultants would be assigned to client projects, would spend months analyzing operations and recommending improvements, would deliver reports and presentations backed by data and expertise. The company had genuine clients who paid for genuine services, had built a reputation over 15 years for competent if unremarkable work that justified the premium fees consulting firms typically charged. But beneath this legitimate operation existed a structural dishonesty that had calcified into accepted practice, that had been maintained for so long it no longer registered as problematic to the people who encountered it in their daily work. A fictional client named Harrington and Blythe appeared in financial reports, in departmental budgets, in project management systems, in billing databases. Teams were occasionally assigned to work on Harrington and Blythe projects. Invoices were generated, payments were processed, revenue was recorded, all the normal mechanisms of client engagement operated exactly as they would for any legitimate customer. Except Harrington and Blythe didn't exist. Had never existed. Was an accounting fiction created 7 years earlier during a period of financial difficulty, a way to smooth quarterly reports and maintain the appearance of stable revenue streams even when actual client work was declining. The original architects of this deception, a former CFO and a handful of senior executives, had intended it as temporary measure, a bridge through a difficult period that would be dismantled once business conditions improved. But it hadn't been dismantled. Instead, it had become institutional practice, had been maintained by successive waves of employees who understood at some level what they were participating in but who had learned not to examine that understanding too closely, who had internalized the logic that this was how sophisticated businesses managed their finances, that creating accounting flexibility was simply prudent management rather than systematic fraud. The original perpetrators had long since left the company, moved on to other positions, retired, in one case died, but their creation persisted, maintained by people who hadn't created it but who had absorbed it into their understanding of normal operations. Ethan Cole was 34 years old and had been working at Virex Solutions for 6 years in the role of senior compliance analyst. His position existed theoretically to ensure the company's operations adhered to legal and regulatory requirements, to identify potential compliance issues before they became problems, to serve as internal check on practices that might expose the company to liability or regulatory sanction. In practice, the role was mostly about documentation, maintaining records that demonstrated the company took compliance seriously, reviewing contracts for standard legal language, preparing reports for auditors that showed appropriate processes were being followed. The work was tedious, detail-oriented, required the kind of systematic attention that many people found exhausting. Ethan had a particular temperament suited to it. He noticed inconsistencies, was bothered by gaps in documentation, felt uncomfortable when systems didn't quite make sense. These qualities had served him well professionally. He was good at his job, was reliable, was the person supervisors assigned to projects requiring careful review. But these same qualities also meant he couldn't easily ignore things that others seemed capable of not seeing, couldn't accept, "That's just how we do it," as sufficient explanation when the underlying logic didn't cohere. He'd first encountered Harrington and Blythe approximately 4 months into his employment with Virex, when he'd been reviewing quarterly financial reports as part of routine compliance documentation. The client appeared in revenue charts, represented approximately 12% of quarterly revenue at that time, seemed unremarkable except for one detail: the documentation folder that should have contained client information, contracts, contact details, project specifications, was essentially empty. Just a few generic internal memos about project scope, no external correspondence, no client signatures on agreements, no evidence of the normal relationship building and communication that characterized work with actual clients. Ethan had flagged this to his supervisor, a woman named Patricia who'd been with the company for 12 years and who seemed perpetually exhausted by compliance requirements she clearly viewed as bureaucratic obstacles rather than meaningful safeguards. "That's a confidential client," she'd said without looking up from her computer screen. "Executive level. We don't maintain the same documentation." This explanation had seemed plausible at the time. Ethan was relatively new, didn't fully understand the company's practices, could accept that there might be legitimate reasons for handling certain clients differently. And he'd been busy with other projects, hadn't had time to dwell on one missing documentation folder when there were dozens of other compliance tasks requiring attention, but he'd noticed the client's name repeatedly over the following years. Harrington and Blythe appeared in quarterly reports, in annual budgets, in project management systems. The revenue it represented grew over time, 12% in his first year, 15% by his third year, 18% in the most recent quarter. That growth should have corresponded with increased activity, more projects, more internal communication about deliverables and client satisfaction. But the documentation remained essentially unchanged, minimal, generic, containing no evidence of actual client engagement. Ethan's discomfort with Harrington and Blythe accumulated slowly, through repeated small observations that individually seemed insignificant but that collectively suggested something fundamentally wrong. He'd be reviewing project assignments and would see teams allocated to Harrington and Blythe work, consultants spending weeks developing presentations and reports for this client, but he'd never hear anyone mention actually meeting with client representatives or receiving feedback or discussing client needs in the detailed way that characterized all other consulting engagements. He'd attend company-wide meetings where executives would reference strong performance with key clients, would sometimes specifically mention Harrington and Blythe as example of successful long-term relationship, but these references were always vague, never included the kind of specific anecdotes or client quotes that speakers typically used when discussing other major accounts. It was as if everyone knew they should acknowledge this important client but no one quite knew what to say about it beyond acknowledging its existence. He'd be processing invoices and would notice that Harrington and Blythe payments always arrived exactly on time, 30 days after invoice date, never early, never late, always for the exact amount billed with no disputes or adjustments. This perfect payment behavior should have been noteworthy, should have been something the finance department celebrated as example of ideal client relationship. But no one ever mentioned it, as if the consistency was somehow unremarkable or perhaps something people had learned not to comment on. And all communication with Harrington and Blythe happened through a single internal email address, hb.projects@virex.co. Not an external address with its own domain, but an internal one, technically belonging to Virex's own email system. When Ethan asked about this during a project review meeting, a senior consultant had explained that the client preferred centralized communication for security reasons, that this arrangement had been established years ago and had worked well. This explanation was accepted by others in the meeting without apparent concern, suggesting either they'd received the same explanation previously or they'd learned not to question these arrangements. But internal email addresses didn't make sense for client communication. Security-conscious clients would use their own secure systems, would have their own domains and communication protocols. Having all client communication flow through an address that existed on Virex's own servers was backwards, suggested communication wasn't actually going to an external entity but was just circulating within Virex's own systems. Ethan had started keeping notes. Not officially, not as part of any formal investigation, just personal documentation of observations that bothered him. The notes accumulated over months, dates when Harrington and Blythe appeared in various reports, discrepancies in how the client was referenced, patterns in billing and payment that didn't match any other client relationship. He wasn't sure what he was documenting or why, just knew that the inconsistencies were numerous enough and troubling enough that he wanted external record of what he was noticing, that he didn't trust his memory to maintain accurate catalog of these accumulating concerns. He began staying late at the office occasionally, using the quiet evening hours when most employees had left to examine systems and records he didn't have time to scrutinize during normal business hours when his attention was consumed by routine compliance tasks. The building took on different character after 7 p.m. The open office spaces that buzzed with activity during the day became empty and silent, the overhead lighting dimmed to energy-saving mode, the city visible through the floor-to-ceiling windows transforming from busy financial district to more atmospheric nighttime landscape of illuminated buildings and distant traffic. Ethan found he could think more clearly in these evening hours, could follow threads of investigation without interruption, could access systems and review records without concern about colleagues noticing what he was examining and asking questions he wasn't ready to answer. He'd make coffee in the communal kitchen where the expensive machine now served only him, would settle at his workstation with the building's late-night silence broken only by the HVAC system's hum and the occasional elevator chime from somewhere distant, would methodically work through financial records and project documentation looking for patterns. 3 months of evening research eventually revealed what Ethan had increasingly suspected but had been reluctant to fully articulate: Harrington and Blythe wasn't a real client. The revenue attributed to it wasn't coming from external sources but was being generated through internal financial mechanisms that created the appearance of client payments without actual money flowing into the company from outside. The specific mechanisms were sophisticated, involved several layers of accounting entries that would be difficult for casual observers to trace. But the fundamental structure was clear once Ethan assembled the complete picture. Virex had created internal budget allocations to a fictional department, had used those allocations to generate invoices to the fictional client, had recorded those invoices as receivables, had then transferred money from other internal accounts to close those receivables, creating the appearance of payment. The money was just circulating within the company's own financial systems, but the accounting entries created documentation that looked like legitimate client revenue. The purpose was to smooth financial reports, to maintain appearance of stable revenue streams even when actual client work fluctuated, to show investors and lenders consistent growth rather than the volatility that actually characterized the consulting business. During quarters when actual client revenue fell short of projections, the fictional client's payments would increase to make up the difference. During quarters when actual revenue exceeded projections, the fictional client's activity would decrease. The result was financial reports that showed steady, predictable performance that bore little relationship to the company's actual business conditions. This had been going on for 7 years. The original motivation, Ethan found archived emails from the former CFO who'd apparently designed the system, had been to bridge a temporary financial difficulty during an economic recession when several major clients had canceled contracts and the company had faced serious cash flow problems. Creating the fictional client had allowed Virex to show lenders stable revenue, to maintain credit lines that would have been reduced or cancelled if the true financial situation had been disclosed, to survive a period that might otherwise have forced bankruptcy or fire sales. But the recession had ended. Business had recovered. Client relationships had been rebuilt. The company's actual financial position had improved substantially. Yet the fictional client had been maintained, had been normalized, had become part of standard operating procedures. New executives had joined the company and had been quietly informed about the arrangement, had been told this was sophisticated financial management that all successful businesses engaged in, had accepted this explanation and had perpetuated the system. Employees who worked on Harrington and Blythe projects, consultants who spent weeks developing presentations and reports that were filed away without ever being delivered to actual clients, seemed to understand at some level that this work was different from their other projects, that the normal feedback loops and client interactions didn't exist, that they were participating in performance rather than substance. But they'd learned not to question too directly, had absorbed the signals that curiosity about this particular client wasn't welcome, had accepted that this was part of working for a sophisticated corporate entity that managed its finances in ways that weren't fully transparent to junior staff. The system had perpetuated through this combination of explicit knowledge among senior leadership and tactical ignorance among most employees, through the normalization of practices that would seem clearly fraudulent if examined directly but that became invisible when embedded in routine operations, through the collective commitment to not questioning too hard or looking too closely at mechanisms that everyone benefited from, stable employment, consistent bonuses, the appearance of working for successful company, even if those benefits rested on dishonest foundation. Ethan sat in the empty office at 11 p.m. on a Thursday evening, financial records and project documentation spread across multiple screens, the pattern finally complete and undeniable. His hands were shaking slightly, not from fear exactly, more from the weight of recognition that he'd uncovered something significant, something that would require decisions and actions that would have consequences he couldn't fully predict or control. He could ignore this. Could close the files, delete his notes, go back to focusing on routine compliance tasks that didn't threaten the entire organization. No one was asking him to investigate Harrington and Blythe. No one expected him to identify this problem. He could simply not know what he now knew, could choose comfortable ignorance over uncomfortable knowledge. But he did know. Had assembled evidence too systematically to pretend uncertainty. Had documentation that would be discoverable if any external auditor ever looked carefully, that would expose him as having known and having chosen not to report. Had personal and professional integrity that wouldn't allow him to participate in systematic fraud even through passive complicity. He spent the weekend thinking about what to do, about how to approach this, about what reporting this would mean for the company and for his own position within it. He had no illusions that being the person who exposed this would be celebrated. Whistleblowers rarely were, even when they were clearly acting appropriately. More likely he'd be marginalized, would be labeled as troublemaker who didn't understand sophisticated business practices, would be pushed out eventually even if not fired immediately. But the alternative, continuing to work for company he now knew was systematically deceptive, continuing to file compliance reports that were themselves part of the deception, continuing to participate even passively in fraud, felt intolerable. He'd taken this position because he believed compliance work mattered, because he thought preventing wrongdoing was important contribution. Learning about wrongdoing and choosing not to address it would make him complicit in ways that contradicted everything he'd thought he believed about professional ethics and personal integrity. On Monday morning, Ethan requested meeting with the board of directors. This was unusual. Compliance analysts didn't typically have direct access to board-level leadership, communications flowed through management hierarchy, but he framed his request as urgent compliance matter requiring board attention, which triggered protocols that allowed him to bypass normal channels. The meeting was scheduled for Wednesday afternoon in the executive conference room on the 17th floor, a space Ethan had never accessed before. The room embodied corporate authority, massive table, leather chairs, screens for presentations, windows overlooking the city from height that reinforced the elevation of people who occupied these spaces. 6 board members attended along with the CEO and CFO, all dressed in business formal attire that contrasted with Ethan's business casual clothing, all carrying themselves with the confidence of people accustomed to making consequential decisions. Ethan presented his findings methodically. Showed the documentation he'd assembled, explained the financial mechanisms, demonstrated how Harrington and Blythe functioned as accounting fiction rather than legitimate client. He kept his tone neutral, didn't make accusations about intent or character, just laid out evidence and let the board members draw their own conclusions about what it meant. They listened without interruption. Their faces showed various reactions: surprise, concern, calculation, what might have been resignation. When he finished, heavy silence filled the room for perhaps 30 seconds that felt much longer. Finally, the chairman, man in his mid-60s who'd been on the board for 9 years, spoke. "You understand what you're asking us to undo? This system has been part of our financial management for 7 years. Unwinding it will require restating historical financial reports. Will trigger questions from auditors, possibly regulatory investigation. Will almost certainly affect our stock price, our credit relationships, our client confidence. You're asking us to create significant disruption to address something that hasn't caused any immediate problems. It's fraud," Ethan said quietly. "It's systematic, sustained financial fraud. The fact that it hasn't been discovered yet doesn't make it acceptable. And it will be discovered eventually, either by external auditors or regulators or in ways we can't predict. When that happens, the consequences will be much worse than if we disclose voluntarily now. The CFO, woman in her early 40s who joined the company 4 years earlier, after the fictional client had been established, spoke next. I inherited this system. Was told it was standard practice, sophisticated financial management. I'm not defending it, but I want to be clear I didn't create it. I understand, Ethan replied. But you've maintained it. We've all maintained it, everyone who knew about it and chose not to address it. The question now isn't who's responsible for history but what we do going forward. Discussion continued for 90 minutes. Board members asked questions about alternatives, about whether there were ways to address the problem without full public disclosure, about what the legal requirements actually were versus what might be practically necessary. The CEO, man in his late 50s who'd been with the company for 12 years, who'd been COO when the fictional client was created, was notably silent throughout most of the discussion, his expression suggesting he understood his career was likely ending regardless of what the board decided. Eventually, the chairman called for private board discussion, asked Ethan to wait outside. Ethan sat in the executive waiting area for 45 minutes, uncertain what decision was being made, aware that his professional future at Virex was probably over regardless of the outcome. Either the board would accept his findings and would initiate disclosure process that would create turmoil he'd be associated with. Or they'd reject his findings and would find ways to push him out for creating problems. The chairman emerged and called him back into the conference room. We're going to address this, he said simply. We're engaging external counsel to advise on disclosure requirements and process. We're going to restate our financial reports. We're going to dismantle the fictional client structure. This will be difficult and disruptive, but you're right that it needs to be done. Ethan felt something release in his chest, relief mixed with apprehension about what came next. Thank you, he said. Don't thank us yet, the chairman replied. This is going to be painful for everyone involved. But thank you for bringing it to our attention. I know that wasn't easy. The following weeks were exactly as difficult as predicted. Virex engaged law firms specializing in corporate compliance to review Ethan's findings and to advise on disclosure obligations. The attorneys confirmed what Ethan had concluded: this constituted financial fraud that needed to be reported to regulators and disclosed to investors. The company issued revised financial disclosures acknowledging that significant portion of reported revenue over previous 7 years had come from internal accounting mechanisms rather than actual client relationships. The announcement triggered immediate negative reaction. Stock price dropped 23% in single day, credit rating was downgraded, several major clients initiated reviews of their relationships with Virex, financial media ran stories questioning the company's integrity and governance. Internally, trust and morale deteriorated. Employees who'd had no knowledge of the fictional client felt betrayed by leadership who deceived them about the company's actual performance. Employees who'd had some knowledge felt exposed, worried about whether they'd be held accountable for complicity. The CEO resigned. The CFO resigned. Several board members declined to stand for re-election. The company initiated comprehensive review of financial controls and compliance processes, implementing new safeguards and oversight mechanisms designed to prevent similar problems. Ethan remained employed but was effectively isolated. He wasn't fired, that would have been obvious retaliation that would create legal exposure, but he was transferred to different role with reduced responsibilities, was excluded from meetings and projects, was clearly being managed out gradually. His colleagues treated him with wary distance, uncertain whether he was hero or pariah, whether his actions had saved the company or destroyed it. The regulatory investigation proceeded slowly. Federal securities regulators examined the company's disclosures and financial reporting practices, interviewed executives and board members, reviewed documentation. After 8 months, they issued findings that Virex had violated securities regulations but that the violations appeared to be a result of poor governance rather than criminal intent. The company paid significant financial penalties and agreed to enhanced oversight for 3 years, but no criminal charges were filed against individuals. The company survived. gradually rebuilt client relationships, restored credibility through improved financial controls and transparency, attracted new leadership committed to ethical operations. Stock price recovered partially though never returned to pre-disclosure levels. The company was smaller, more cautious, less aggressively profitable than it had been, but more stable, more honest, more aligned with the values it claimed to represent. Ethan left Virex after 14 months, recognizing his position there had become untenable. He found different compliance position at smaller company, brought with him hard-won understanding of how easily systematic dishonesty could become normalized, how important it was to question systems everyone else accepted, how costly integrity could be but how necessary. 2 years after the disclosure, Ethan occasionally walked past the glass tower that housed Virex Solutions, observed it from street level as just another corporate building in the financial district, indistinguishable from dozens of others except in his own memory and knowledge of what had occurred within its polished spaces. The building's directory no longer listed Harrington and Blythe among the company's clients. That fictional entity had been quietly erased from all systems, archived as historical record of a mistake rather than maintained as ongoing practice. Ethan had learned several things from the experience. First, that ethical compromises rarely announce themselves dramatically but instead accumulate gradually through small decisions that individually seem pragmatic but that collectively create systematic dishonesty. The people who created Harrington and Blythe hadn't been uniquely corrupt, they'd been responding to genuine business pressures with solutions that seemed temporary and defensible at the time. The people who maintained it hadn't been consciously choosing fraud, they'd been accepting established practices without examining them critically, had been trusting that sophisticated business operations might involve complexities they didn't fully understand. Second, that organizations develop immune systems against internal challenge, mechanisms both subtle and overt that discourage questioning established practices, that marginalize people who notice problems, that create incentives for accepting rather than examining. Ethan's colleagues hadn't been cowards for not noticing Harrington and Blythe's fictional nature, they'd been responding rationally to signals that curiosity about certain matters wasn't welcome, that career advancement required accepting rather than challenging, that organizational belonging meant not seeing things that would create discomfort if acknowledged. Third, that doing the right thing didn't guarantee positive outcomes and often created significant personal and professional costs. Ethan had acted with integrity, had reported wrongdoing through proper channels, had done exactly what compliance professionals are supposed to do. And he'd been effectively driven out of his position, had acquired reputation as difficult employee, had created complications that harmed many people who'd had no role in creating the problem he'd exposed. But he'd also learned that living with himself required acting according to his understanding of right and wrong even when that action created costs, that participating in systematic dishonesty, even passively, even through simple silence, would have been corrosive to his sense of self in ways that would have been difficult to repair. The temporary discomfort of challenging wrongdoing was preferable to the permanent discomfort of knowing he'd chosen complicity. He now worked for a smaller consulting firm, had similar compliance responsibilities, approached his work with heightened awareness of how easily organizations could drift into ethical compromises. He looked for the small signs, practices that everyone accepted but no one could quite explain, systems that seemed designed to obscure rather than illuminate, questions that colleagues avoided asking. He tried to create cultures where questioning was encouraged rather than discouraged, where transparency was valued rather than feared, where doing right thing was supported rather than punished. This work was ongoing, would never be finished, required constant attention because the pressures that created ethical compromises never disappeared, they were inherent to organizational life, to the perpetual tension between ideals and practical operations, between what should be done and what's convenient to do. But paying attention mattered. Questioning mattered. Refusing to normalize dishonesty mattered. The glass tower where Virex Solutions operated was still visible from several locations in Ethan's daily commute, still stood as reminder of what he discovered there and what he'd done about it. Most people walking past it never thought about the systematic fraud that had operated within those polished spaces for 7 years, never knew how easily sophisticated deception could be embedded in routine operations, never questioned whether their own workplaces might contain similar fictions that everyone had learned not to see. But Ethan knew. And that knowledge informed everything about how he approached his work now, how he thought about organizational ethics, how he understood his own responsibility to notice and to question and to act when noticing and questioning revealed problems that everyone else was choosing to ignore. The client that never existed had been erased from Virex's systems. But the lesson it taught, about how dishonesty becomes normalized, about the cost of questioning, about the necessity of maintaining ethical clarity even when doing so creates difficulties, that lesson remained. Would remain for however long Ethan continued doing compliance work, continued paying attention to the gap between how organizations claimed to operate and how they actually functioned, continued choosing to see what many people found it more comfortable to ignore. If something exists only because no one challenges it, it doesn't deserve to exist at all. This is what Ethan learned through discovering and exposing Harrington and Blythe, that much of what operates under the cover of normal business practice exists not because it's legitimate but because questioning has been systematically discouraged, that organizations develop powerful mechanisms for normalizing practices that should be challenged, that maintaining ethical clarity requires constant attention and willingness to accept costs that come with refusing to participate in collective fictions. The fictional client existed for 7 years not because it was well hidden but because everyone who encountered it learned not to look too closely, not to ask too many questions, not to challenge something that seemed to be accepted by people with more authority or longer tenure. This learning wasn't dramatic, wasn't explicit instructions to ignore obvious fraud, but gradual socialization into understanding what was and wasn't appropriate to notice, what questions would be welcomed versus what questions would mark someone as not understanding how sophisticated businesses operate. This pattern extends far beyond Virex solutions, far beyond financial fraud specifically. Organizations of all kinds develop practices that serve institutional interests while contradicting stated values, that persist through collective agreement not to examine them too carefully, that remain unchallenged because challenging would create discomfort or disruption. These practices range from minor to severe, from technical violations to fundamental betrayals of purpose, but they share common feature: they exist in the gap between what organizations claim to be and what they actually are, maintained through systematic discouragement of the kind of attention that would reveal the gap. Questioning these practices is difficult. It requires noticing inconsistencies that others ignore, asking questions that colleagues find uncomfortable, challenging systems that seem to be functioning adequately for most people. It requires accepting that you might be wrong, might be misunderstanding sophisticated practices, might be creating problems where none actually exist. And it requires accepting that even if you're right, that bringing problems to light might create costs for yourself and others, that organizations often respond to whistleblowing by marginalizing whistleblowers rather than addressing problems. But not questioning is also a choice to participate in whatever deceptions or compromises exist within the systems you work within, a choice to prioritize personal comfort over institutional integrity, a choice to benefit from structures you know or suspect to be wrong without taking responsibility for addressing them. So develop capacity for appropriate skepticism. Notice when explanations don't quite make sense, when practices everyone accepts can't actually be justified, when systems seem designed to obscure rather than illuminate. Ask questions even when asking creates discomfort. Document what you observe. Escalate concerns through proper channels. Accept that doing so might create professional costs but also recognize that not doing so creates ethical costs that compound over time. And if you're in positions of authority within organizations, create cultures where questioning is encouraged rather than discouraged, where people who notice problems are valued rather than marginalized, where transparency is practiced rather than just claimed. Build systems with appropriate oversight and accountability. Don't assume that long-standing practices are legitimate just because they've persisted. Examine them regularly, question whether they align with stated values, be willing to dismantle them when examination reveals problems. The client that never existed was finally erased from Virex's systems. But countless other fictions persist in countless other organizations, maintained through collective agreement not to look too closely, waiting for someone with enough integrity and courage to notice and to question and to act despite the costs that noticing and questioning and acting will likely create. Question wisely. Live transparently. Be story-wise.